Every day, we use systems we don't fully understand. We swipe a card, buy a stock, or transfer money, and it all feels instant. But behind the screen, there is a messy, aging web of cables and old code holding the global economy together. Most people think the big evolution in finance is just about making things digital, but money has been digital for a very long time. But the real problem here is that the digital system used by Wall Street don't talk to the new world of blockchain. For years, people, they have tried to force these two worlds together using wrappers and bridges, but these are just straight out band-aids on a broken pipe. And right now, a giant entity that starts with N and ends in Q is quietly signaling that the era of band-aids is over. They aren't just looking for a new way to trade. They are looking for a new way for the world's assets to exist. This isn't a small upgrade at all. It is a fundamental rewriting of how ownership actually works. And if you want to really understand where the actual global financial structure is going in all this, you have to look past the headlines and into the actual plumbing itself. And by the end of this conversation, you will understand why the current way we try to say put real world assets on a blockchain is fundamentally flawed, and why the biggest players in finance right now as we speak in the background are moving towards a completely different solution. And we are going to break down a specific regulatory filing from early 2026 that lays out a set of rules that blockchains simply cannot follow. And you'll see how a massive technical gap in the market has been created and why a technology called chain fusion is currently the only thing positioned to actually fill it. That's why this is so massive. And we'll look at the depository trust and the clearing corporation, or as they call the DTCC, and their project Ion, which handles hundreds, I'm talking hundreds of thousands of trades every single day. And we're going to explore why wrapping, say, a stock is a legal nightmare and how a new form of direct interaction is making that process obsolete. Because this is all about seeing the invisible architecture of the future before it becomes common knowledge. And we are moving, from a world of, just say, crypto, 20 tokens, experiments, meme coins, shit coins, vaporware, to a world of actual institutional infrastructure. And the requirement for this new era that we'll be moving into is much stricter than what most people realize. The transition takes time, and to understand why this is happening in the background. And I want to share also lessons I learned from my time, working in traditional finance, observing things in traditional financial markets over many years ago. I've watched how simple clerical errors, say, in a back office settlement could freeze millions or tens of millions of dollars for days. So in the old world of finance, when you say buy a share of a company, it's not like buying a loaf of bread where you hand over cash and take the bread home with you. It's definitely not. It is a complex stance involving multiple banks simultaneously. We're talking clearinghouses here and a central database called the DTC. One thing is, I could tell you that what experience taught me and all that, is that the system, it doesn't care about the actual speed as much as it cares about identity. For instance, every stock has a fingerprint called a QSIP, It's a QSIP number. And if that fingerprint doesn't match perfectly across every underlying ledger, the whole trade breaks itself. And this brings us to a huge problem in the blockchain world that we are going through right now today. Because when people talk about, tokenizing a stock, like Apple, for example, they usually talk about wrapping it. And imagine, okay, you have a gold bar in a vault, okay? You can't move the gold bar easily. It's difficult to move, you know? So you print a piece of paper that says, this paper represents 1 gold bar. Okay. That paper is a wrapped asset. But in the eyes of the actual law and the SEC, that piece of paper is not the gold bar. It is a new thing, a derivative. It has its own rules, its own underlying risks. And most importantly in all this, it doesn't have the same CUSIP as the original physical gold bar. A recent NASDAQ filing known as SR NASDAQ-2025-072 has pulled the rug out from under this wrapping strategy. This filing that was set a rules for how tokenized securities actually should be traded. And one of the most important rules in all this is that a tokenized share must trade on the same order book itself and keep the same CUSIP as the traditional underlying share. And this sounds like a small detail, but it's not. But for the 99% of blockchains, to be able to do this is a total deal breaker. They just can't do it. Because if you wrap a stock, for example, you've created a second asset in itself, okay? And NASDAQ is saying they don't want a second asset. They want the underlying original asset to live in 2 worlds at once, okay? And this is where the World Computer Internet Computer comes in, or ICP. And this is how I see it from Fabio's clue, because this comes into the picture through something called chain fusion. Okay. And think of chain fusion like a universal translator. Okay. That also has the keys to every door. Instead of just making a copy of a stock, what ICP will do will allow a smart contract, what they call a counter stock, okay, to talk directly to the existing databases of the traditional financial world. It doesn't need to make a wrapped version in all this. It just can reach out, verify the ownership on the legacy system itself, and update that in real time. And I can tell you from a structural perspective in this is the difference between, say, taking a photo of a car, for example, and actually driving the car itself. And I could tell you from my experience in the traditional finance world, I saw this pattern repeat long before it was obvious to the normal eye. The winners are never the ones who try to replace the entire system overnight. The actual winners are the ones who make the existing systems work better without breaking the underlying rules. NASDAQ and the DTC are massive ships that turn very, very slowly. They are going to throw away decades of legal framework just to use, say, a new technology. Definitely not. They need the underlying technology to adapt to them. And the DTC's Project Ion is a great example of this, because it's a platform that already in itself processes over 1,000 equity transactions a day using blockchain technology. But here is the catch in all this. For this to work, say, on a global scale, you need atomic settlement in all this. So say this is a fancy way of saying that the money and the stock must change hands at the exact same millisecond. Because in the old system, this could take 2 days, which we call T plus 2, 2 days plus T plus 2 day settlement. And during those 2 days, a lot of things can go wrong. You know, I remember seeing situations where a firm would go bust during that 2-day waiting period. Okay, just leaving the other side of the trade holding nothing but a promise. To solve this, you need 2 fundamental, incredible things: speed and the ability to talk to legacy systems themselves. And ICP has a finality of under a second. We're talking 0.47 seconds. This matches the speed of the high-powered engines NASDAQ uses to match buyers and sellers. But the secret sauce is something called HTTPS alcohols, because most blockchains, okay, are like a person in a soundproof room. They lock themselves up there. They can't hear what's happening outside unless someone brings them a note. And this is dangerous because the person bringing the actual note could be lying. Who knows? And HTTPS, our cores allow the ICP network to securely hear and to talk to the outside world directly. You can check a bank's private API or the DT's ledger to make sure the money is actually there before it finishes a trade. And this is what creates a handshake between the old world of banks and the new world of blockchain. And that is what we call seamless transaction. And most importantly here, verified by the underlying code itself. And another massive war for big institutions here is the bridge, the dependencies. And if you want to move value, say, from one blockchain to another, what do you usually need to do? You need to use a bridge. But we know bridges are historically the weakest point in the entire transaction and the underlying ecosystem themselves. They are like a bridge over a river, okay, that is constantly being attacked from different vectors. And if the bridge collapses in itself, everyone's money on both sides of the ledgers are gone. And huge companies like NASDAQ cannot take that sort of risk. They need a system with no middlemen. And this is where the math behind the World Computer ICP, specifically something called chain key cryptography, comes into the picture, and it becomes so important. Because instead of a bridge, it uses a decentralized group of computers to sign transactions. No single person or computer ever has the key to the vault. It's like a bank vault, okay? That requires 50 different people to turn their keys at the exact same time. But none of those people actually know what their key looks like. And this makes the network itself look like a single, highly secure user to the DTC. It's not a risky third-party software. It is a fundamentally secure, decentralized vault. And I can tell you in my experience in finance, what mattered in the long run wasn't the hype of a new product, but the underlying structure of how it was built. And when I looked at how large-scale settlements happened in the past, it was always the most robust and boringly secure systems that inevitably won. The zero to hero riddle, which Fabio put out that pointed to NASDAQ, wasn't just a fun game for a community, beginning with N, starting with Q. It was a clue about where the real requirements are being written. And that's how I see it. I don't know if I'm exactly right, but that's how I see it, because NASDAQ is setting the stage for a unified order book where there is no difference between a digital share and a traditional share. And the reason NASDAQ is the only logical answer to the riddle and why it points directly to the internet computer comes down to a perfect storm of regulatory requirements and technical limitations in themselves. And to understand why this is likely the truth, can't be 100%, we have to look at several unbreakable walls of institutional finance and why ICP is currently the only technology that can actually do this, that is actually built and designed to walk through them. Say, for instance, the QSIP law, which is the legal identity framework. Because I can tell you in traditional finance, every stock has a QSIP number. Okay, this is its DNA, its underlying identity. In the eyes of the SEC and the DTC itself, the entity that actually holds all the stocks, if a token does not have the exact same QSIP as the underlying share sitting in the vault, it is not a share. Okay, it's like voided. And the problem, most blockchains use underlying wrappings in themselves. And if you use a wrap, so you wrap a share of, say, Apple, you create W Apple. Legally, W Apple is a derivative of Apple, a new contract that tracks Apple price. And this is why NASDAQ's filing, or the SR-NASDAQ-2025-0, is so significant here, because it specifically states a mandate that tokenized shares must trade on the same order book, and they must maintain the same QSIP. The logic You cannot trade a derivative wrapped token, for example, on the same order book as the real share. It's a violation of securities law, to put it frank. Therefore, you need a blockchain like ICP that doesn't wrap the asset, but actually fuses it with the legacy system. And ICP's chain fusion is the only architecture in Web3 built to interact with an external ledger, for example, like the TTCs, without creating an actual synthetic middleman token. Now, also could be the bridge wall, which is the underlying security risk. Because I could tell you from my experience, institutions like NASDAQ and the DTC handle trillions of dollars in volume. Okay. They are hyper allergic to bridges. Okay. In the crypto world, bridges, as we know, are notorious for being hacked because they rely on a small group of people or a single piece of vulnerable software to hold it all together, to hold the keys. And the problem in all this is that we're talking $1 trillion exchange here. They cannot risk its entire reputation on a bridge. If the underlying bridge is hacked and if it's running on Web2 and eventually will be hacked, the tokenized version of the stock becomes worthless. And that also in turn creates a systemic financial crisis and risk in itself. And the logic here is NASDAQ requires a system with zero bridge architecture, and ICP uses chain key cryptography in that. Instead of a bridge, the network itself signs transactions using a decentralized threshold signature. And also, to the DTC's computers, the ICP's network looks like a single ultra secure user, not an actual risky third party bridge. And this is the only way an institution like NASDAQ and the DTC of that size can safely interact with a public network at the $1 trillion level. And the Oracle war, the actual communication gap in all this, because blockchains, okay, are typically closed loops when we look at them. They don't know what time it is. They don't know the weather, for example, and they certainly don't know if a bank transfer actually cleared in the real world, unless, for example, an Oracle-like Chainlink tells them. But the problem in all this, for atomic settlement, the goal of the DTC's Project Ion, the blockchain needs to verify that cash has moved in the traditional banking system and rails at the exact time the token moves on the chain. And using a third-party oracle like Chainlink, for example, adds another layer of risk in all this and also delay. And the clear logic here is that ICP has a native feature called HTTPS outcalls. And what this does, it allows the underlying smart contract to call the DTC's private APIs directly. It doesn't need an oracle like Chainlink. It can ask the bank's computer, for example, did the money arrive? And get a verified answer in under a second. And this direct line to traditional finance is a prerequisite for the unified order book NASDAQ is proposing here. But why is it the only logical conclusion in all this? Okay, if you look at the requirements for a global underlying regulated stock exchange like NASDAQ to move onto a blockchain, the checklist, in my opinion, looks like this. No wrapping, okay. Must keep original QSIP. No bridges. Must eliminate the number one source of hacks. Direct communication. Must talk to legacy APIs without any oracles here. Instant finality. Must match the speed of NASDAQ's matching engine. If you can scan the entire blockchain industry from, for example, Ethereum to Solana to private ledgers out there, only the World Computer ICP has all four of these capabilities baked into its core protocol. Nothing else can do this in the Web3 space. The riddle wasn't just about the letter N in Q here. It was about identifying the only entity, NASDAQ, whose regulatory demands match the technical, unique selling points of the World Computer, Internet Computer. And when the NQ entity says, we want a unified order book with original assets, they are describing a world that only chain fusion on the world computer can currently build. And when you look at the 2026 filings, the message is crystal clear here. The industry is moving away from synthetic copies of assets. They don't want that. They want the real thing. They want the original CUSA. They want a system that doesn't rely on those risky, pesky bridges. And when you lay these requirements out on a table, you realize that the architecture ICP has been building for the last several years is almost an exact match for what the regulators are now asking for and demanding for. Institutions usually respond to these shifts very quietly. It's happening in NDAs, it's happening in the background. They don't put out press releases every time. They test a new piece of the plumbing. They test it. They wait until the foundation is solid. They don't jump to these things instantly. And understand these incentives, why a giant like NASDAQ would choose one path over another is much more valuable than actually just reacting to daily price movements and worry about why the price hasn't gone up. Why is the price in double digit? Why the price isn't at 50, 100, 2,000? Because seeing the logic of the machine, the transition we are seeing right now, guys, is a shift from blockchain as a casino vaporware to a blockchain as a utility. Just like the internet was once upon a time, slow, confusing tool for researchers before it became the World Wide Web, the invisible backbone of everything we do today in Web 2. And this technology is becoming the invisible backbone, where we're talking about Web 3, of finance. And the reason this is happening right now as we speak in the background in early 2026 is because the regulatory clarity is finally catching up to the technical capability. Because the SEC proceedings, they aren't just red tape. They are the blueprints for how the next $1 trillion will move. Ultimately here, understanding the difference between wrapped assets and fused assets here can, and I mean can, completely change how you approach this space. Because the key lesson here is simple but powerful. The legal and technical identity of an asset matters more than you think. And historically, I can tell you from experience, data suggests that when the rules of the game change, and they are changing, the players who have the right tools in all this already in their hands are the ones who move forward. And we are transitioning, we are moving towards a world where the stock market itself and the blockchain are the same thing, unified, using the same identifiers and the same underlying order books. And this perspective might just shift the way you see the entire digital landscape. Think about this, okay? The next time, for instance, you hear about a new financial platform, look at the plumbing, not just the paint job covering it, because it could make all the difference how you see things and actually understand which systems will actually stand the test of time. And that's the story behind how the evolution of global giant is pointing towards a very specific technical future here. Because everything comes together, it comes pretty crystal clear when we see it from this angle. With that, we wrap up today's journey. Remember, stay curious, let your journey continue. And if this video cut through the noise and actually gave you clarity, not hype, not hopium, then do 3 things for me right now. Hit like so this reaches people who are tired of being misled. Subscribe because this channel is all about understanding where underlying technology, money, and power shifts are actually going before the headlines catch up. And also comment with what you think and let me know. Do you think I'm right? Do you think we're heading down the right rabbit hole? And tell me what you want broken down next. I read every single comment. I want you to comment this video because I want to hear your perspective if I've hit the nail on the head. And I want to hear it, your point of view. And subscribe now to the channel because everything we've explored today could actually change the way you see global finance forever. Remember, the choices you make today, that we make together today, shapes tomorrow's story. And if this video inspired you, as it's inspired me, give it a like and share it with others. Drop that comment below. And as I said, this video, I really want to hear your thoughts because it would really mean a lot, because I want to get people's perspectives on this, and turn on the notifications so you never miss the next videos I put out, and we can enjoy this adventure together in Web3. And remember in all this to stay decentralized, and I will see you on the internet computer. Until next time.